Hello everyone and welcome to our webinar today on how your FICO score really works. Discover how you can easily control all 5 secret ingredients. I'm really glad everybody could join me today. Today we're going to have an hour packed full of FICO. I'm going to teach you everything you need to know about the FICO score. I'm still very surprised that even professionals in the finance space that do not know how this score works. And that's really one of the reasons that we're doing this webinar. I want you to know exactly how your FICO score works, because once you understand the methodology behind it, it's actually very easy to control your score. But not knowing how the score works creates all kinds of problems because you're just kind of dealing with whatever you get without the ability to actually control it, which isn't good. So before we dive in too far, let me first introduce myself. For those of you that don't know me, my name is Ty Crandall. I'm actually the Director of Business Services here at Credit Suite. What I do is I help companies offer business credit and financing for their customers. We also help customers obtain business credit and financing for their business. But what a lot of you already know is that I have a history in credit repair. I built and sold one of the largest credit repair companies in the Southeast United States. So before I ever started talking about business credit reporting agencies, I've always been an advocate out there teaching everybody there is to know about the consumer credit scoring system. In my career, I've seen over 10,000 credit reports. I've been involved in the process of lending hundreds of millions of dollars across many different consumer and business sectors. So I know a lot about the consumer and business reporting systems. And that's exactly what we're going to dive in today. We're going to talk about all aspects of FICO, FICO 9, the brand new FICO score that just rolled out. We're going to dissect the FICO score. You're going to leave here knowing everything there is to know about the FICO score. Now, before we dive in too deep, I want to tell you two things. If you attend this webinar through its entirety, I will send you a playback of the webinar. It'll probably come as soon as today. Probably tomorrow it's going to show up in your inbox. I talk pretty fast. I move pretty fast. It's just the way my brain kind of operates. So if you miss information, don't worry. I'll send you a playback where you can pause, stop, write down anything that you want to write down. The second thing is I will not have time for questions at the end of this webinar. I have another webinar right after this one for our active clients. So right there's my email address. You'll see it at the end too, ty@creditsuite.com. I will always get your questions answered if you send me an email. So even though I might not have time to answer these questions on this webinar, if you do send me an email, I will make sure that all of your questions are answered. So enough about me. Let's dive in. We've got a lot of stuff to talk about today. So first of all, let's talk about who is FICO? Well, FICO is a business analytics software company that's based out of San Jose, California. Now, FICO was actually founded way back when, in 1956, by two gentlemen. One was named Bill Fair, and the other was named Earl Isaac. Now, their FICO scores become obviously very popular. I don't think there's anybody on here that's not familiar with what a FICO score is, because it's really become the main credit score used to determine consumer risk. There are other credit companies out there that offer analytics solutions like FICO does, but none of which have any of the market share that FICO has. FICO really is the most widely accepted credit score out there, even well surpasses the actual Bureau's credit score itself, which you'll learn about a little bit later today. So FICO was founded in 1956, and they were actually known as the Fair Isaac and Company. That was their actual original name, although they had a few different names. So William Fair was one of the original founders and was an engineer by trade. And Earl Isaac was another founder and was a mathematician by trade. So the two actually met while working at the Stanford Research Institute in Menlo Park, California. And then in 1958, 2 years after their formation, they actually pitched their first credit risk analysis system to 50 American lenders. So they got started. About 2 years later, they had released their first version of the FICO score to 50 of the biggest banks in the actual United States. So FICO actually went public back in 1986, and they still trade on the New York Stock Exchange under the ticker symbol FICO. Now, the company debuted its first general purpose FICO score back in 1989. This was a score score that wasn't just designed for the banks. It was a score that could be used for a lot of different reasons, and that's going to be important to you a little bit later. I always like to talk about a little bit of history in the beginning just so you know how this all started, but a lot of this will tie into what you're about to learn because you're going to see that there's many different versions of the FICO score out there that we'll be diving into a little bit later. But their main FICO score is based on credit reports. That's actually credit report data that's provided by the three major credit reporting agencies, and the scores on the FICO range from 300 to 850. Now, lenders use these scores to gauge a potential borrower's credit worthiness. Even Fannie Mae and Freddie Mac first began using FICO to determine if American consumers could get mortgages. So they actually use this for mortgage qualification in 1995. It kind of seems weird. I mean, that's not that long ago if you think about it. That's like 20 years ago. Fannie and Freddie even started using FICO. But I'll tell you, this was a monumental step in their growth. When Fannie and Freddie started using FICO, that's what really big time put them on the map and made them by far the most widely used credit analytics score that's out there today. So originally called Fair Isaac & Company, the name was changed to Fair Isaac Corporation in 2003. The company rebranded again in 2009 and is now called FICO, making their name the same as their signature score. You know, a lot of people called them FICO, but they never were. They were actually Fair Isaac & Company, then they went to Fair Isaac Corporation, or Fair Isaac is what we always used to call them, and then in 2009 they just kind of figured it out, that the FICO had become a household name, so they decided to rebrand and change their company name to coincide with the actual score that they had released. And they were originally based in San Rafael, California. They moved to Minneapolis in 2004 and then moved back to San Jose, California, which is where they currently are. Just last year, they actually just moved back there. So a lot of FICO expansions, and I'm not going to go through all these. As a matter of fact, I'm just going to pull them all up just like this. So why would you care about this? Well, I think this is important because when you talk about TransUnion, Equifax, and Experian, they grew the same way. You know, somebody had sent me an email this morning from Dublin, Ireland. There's a group of people working on their MBA in college over there, a college named Trinity College, and they wanted to get some quotes from me and some feedback on the actual business credit scoring system. And one of the questions they'd asked I thought was a good one is, do you ever think that Google and companies of that sort, Amazon, Facebook, will ever rival the credit reporting agencies? And my response was absolutely not. They've got too much time behind them. They've grown so big. But a lot of us lose track of how they got as big as they are. And this is how. It's acquisitions. You know, FICO has got as big as they are because they've taken a lot of these smaller companies out there that also offered scoring analytics, and they've purchased them. So as you can see, 90s throughout the early 2000s, even to recent day, FICO has made a significant amount of acquisitions. Now, if you look at TransUnion's history, Experian's history, Equifax's history, you'll see exactly the same thing. These guys got to be as big as they are because they were coming in and buying massive chunks of companies all over the world that offered credit scoring or that offered credit reporting. So they would come in, and credit reporting never used to be like national three companies. It used to be regional. So like in every region, there were little credit reporting information companies. And when the big three came in, they started buying up all of these smaller companies in groves, and that's how they got as big as they are. It's exactly the same with FICO. FICO's partially as big as they are because they've acquired all of these companies that I'm listing here throughout decades to get as big as they are. So all the little guys get in the space, they make a name for themselves, they get a following, and FICO comes in and buys them out. It's part of the reason, again, they're as big as they are. So FICO offers a lot of services. I mean, we're obviously familiar with the FICO Score, but FICO themselves actually provides a lot of different services that customers can pay them for. So customer acquisition analytics. So they can help you get information on who is your best customer to target? What is the best way to target them? What do they respond to? So any analytics that really revolve around getting a new customer, they have services that provide information on that. They have debt management collection analytics that teach you who will pay, who won't pay, the best collection methods and best methods to manage debt for the company that your company actually has. Any of those type of things they provide analytics around. Fraud and security analytics. So They provide a lot of analytics that help prevent fraud in businesses and consumer-wise, and also for actual security. Risk analysis scoring. Okay, so this is obviously credit scoring. This is what you're used to FICO providing, is risk analysis scoring, and this is what they've really got their name for, again, although they offer a lot of these other services. And customer decision making and analytical data solutions. So again, when you're going to make decisions, you make decisions based on metrics. Okay, and this is, for example, why Facebook is now pulling in major money. Remember, when Facebook went public, they did not have a good system to make money. They had a large user base, massive user base, and they had to work within that user base to figure out how to get those people to get them to a point where they could make money. But when you have data, it's not hard to do, because the data will give you a lot of information that will help you make decisions. So now Facebook's very profitable because you can do ads and really focus down to a very specific target, because they're using the analytics they gather to help you make those decisions. That's what FICO does. FICO gathers a lot of data, and then they put these data into these software analysis engines that then help you make better decisions. Whether you run a business, whether you're a consumer, they help you make better decisions, especially for business owners. So this is really what makes them a company, is providing these kind of analytic solutions to help, whether it be for debt or whether it be for customer acquisition or even credit scoring. So now let's dive into the topic at hand, the FICO score itself. So the FICO score is the most widely used credit score in the United States by far. Okay, it's a mathematical model that's used to depict a consumer's risk of going 90 days late on an account within the next 24 months. That exactly is what your FICO score is. That's what it reflects. It tells a creditor your risk of going 3 months, 90 days behind in the next 24 months. Now, this is very similar to what most business credit scores represent. If you look at the Dun & Bradstreet Paydex score, for example, it does it over 12 months. One of the only difference between consumer and business scores is that business scores measure the risk of going 90 days late in the next 12 months. Consumer scores measure the risk of going 90 days late in the next 24 months. Both Vantage Score from the bureaus and FICO Score are both the same way. That is exactly what the FICO Score actually represents. Now, lenders use the FICO Score to help them make billions of credit decisions every year, and FICO calculates the score based solely on information in your consumer credit reports named at the credit reporting agencies. Okay, this is different. If you look at business credit scores, they get data from a lot of different places. They get data from a lot of different sources that they use to calculate your score. But in consumer credit scoring, all they do is get the information from the 3 credit reporting agencies, and that will actually determine your score. And FICO credit scores, again, range from 300 to 850, which I'd already mentioned. So the FICO score is calculated by a mathematical equation that evaluates many types of information from your credit report at that credit reporting agency. And then by comparing this information to patterns in hundreds of thousands, if not millions of past credit reports, the FICO score estimates your level of future risk. So if you have actually 3 main FICO scores, each actual reporting agency has their own. Now, they all used to name them like completely different. Like I think TransUnion was known as Empirica, and I think Equifax was FICO, and Experian was like something else. So they all used to name them very different. Now they're very similar names. And each FICO score is based on information the credit bureau keeps on file about you. So if you want to know why information is different from your Equifax, TU, and Experian reports, that's why. Because all that score reflects is based on the data they have. They take the data from their report and they use it to calculate a score. And if Equifax has different data than TransUnion and TransUnion has different data than Experian, then all the scores are different. And if you look at a credit report, that's what you'll find. You'll find that you might have a credit card that only reports to TU and Equifax, not Experian. You might have a car loan that reports to Experian and Equifax, but not TransUnion. So certain companies report to only one or two of the reporting agencies, sometimes three, and because each report has different information, that's the main reason that your actual score is different. So the FICO score from each reporting agency considers only the data in your credit reports at that agency, which is exactly why the information between agencies is so much different. Now, your credit score may be different at each of the main credit reporting agencies. Again, if your current sources from the credit reporting agencies are different or scores are different, it's because the information they have is different. And if your information is identical at all three reporting agencies, which very rarely is it, then that means that your FICO score would be pretty close. So if all three reporting agencies have the same information, then that would mean that all three of those reporting scores would be pretty similar. But what you're typically going to find is that's not the case. Like Experian. There's a lot of people out there that just don't report to Experian. So as a result, your TU and Equifax scores will always look usually very different from Experian because not as many people report to them, so you won't have as much trade data actually being reported. Now, for your FICO score to be calculated, your credit report with the bureau from which you want your score must contain enough information and enough recent information on which to base your score. So, look, a lot of you here probably already have a credit score, but it's interesting to know what it requires to actually get a FICO score. So what this means is it means you have to have at least one account that's been open for 6 months or longer, and at least one account that's been reported to the credit reporting agency within the last 6 months. So this is what it takes for you to even get a FICO score. If you don't have an account reported for 6 months, you'll never get a FICO score. You won't get a FICO. That's what happens. So this is very different in the business world because in the business credit world, we could build an entire business credit report score. We can get somebody 20 trade lines. We can get them cash credit cards for $5,000, $10,000 limits all within 6 months. But in the consumer world, it takes 6 months to even get a score. In the business credit world, we can get somebody a score in 30 to 90 days. But in the consumer world, no matter what you do, you can't even get a score until you have an account report 6 months at least, and that account has to be recent for FICO to actually issue an actual score. So now I'm going to talk to you a little bit more about different types of score. I get a lot of these type of questions. Why is it that when I go to get a car loan, my score is different than the scores I pull online in my credit monitoring? Or why did I go to get a mortgage and my score be 150 points different from what it is on what I see in my credit monitoring or what that car dealership pulled? Well, that's all because there's a lot of different kinds of credit scores out there. So there's many different kinds of credit scores that are actually available today. There are credit scores consumers can pull themselves through credit monitoring. Okay, you're familiar with those, whether it be there's just so many of different credit monitoring services that are out there. Identity Guard being one that I use. There's a lot of different companies. So you see the score that you see on credit monitoring. You go to apply for a mortgage at a bank or a mortgage broker. You'll have a different score there. You'll have a different score if you actually go to get a car loan. The people that give you credit cards actually pull different scores than all the rest of these that we've discussed. So what these are called is these are called scorecards. And this might not be 100% accurate number because this number changes all over the place. But last time it was published how many scorecards there were, FICO announced that there were 16 different scorecards that exist today. So what these scorecards are is these basically reflect different credit scores that are designed to give more insight into particular industries. So you'll basically see that every major industry, credit cards, auto loans, mortgages, each one of these has their own scorecard that's different from each other. So the mortgage industry, for example, is more concerned with the consumer's past mortgage history than anything else. This makes perfect sense, right? If you're going to get a home loan and you have a credit report with 50 items on there and one of those items is a mortgage, which do you think they're going to be more concerned with? Like, they're more concerned with how you pay your mortgage than anything else. Don't get me wrong. Everything else is obviously important, but not as important as your mortgage history. So what happens with this mortgage score is that they weight your mortgage history heavier into the score calculation than other accounts. So FICO works primarily the same for car dealerships and mortgage brokers. The difference is how much weight, how much value they give to one kind of account. And if you apply for a mortgage or a home loan, they give more value towards any past mortgage account that you've had. So a consumer's credit monitoring score might be 660. Like you go and you pull your own credit score on your credit monitoring and you see it's a 660. But then when you go for a mortgage, you might see that that score is like way lower due to some past negative mortgage accounts on the report. And when I get this question, this is how I usually answer it too. Someone will say, look, man, I just went and got a mortgage, and my mortgage score was like 100 points lower than my consumer credit score. And my response is always the same. Well, that would reflect that you probably have slow pays on a past mortgage. And their response would be, I actually do. Well, yeah, that's why that score's low. It also works the opposite. If you have really good history on your mortgage, then that could mean that you have a higher score, a higher mortgage score than you would pull through your own credit monitoring itself. So this is why these scores are different. It's really based on just weighting one factor heavier than anything else. So a credit score that a consumer pulls themselves will not be the same as the mortgage industry option score that lenders and brokers use to access mortgage default risk. Now, it's funny because when I owned a credit repair business, I would commonly talk to mortgage brokers, and we would talk to them about how we could help their consumers improve their scores. And it was always funny because the response we would get is, I know credit, I know everything about credit, but a lot of the mortgage brokers we talked to knew nothing about FICO. They didn't know how FICO was calculated. They didn't know the 5 components. And to date, I have never talked to any banker or any mortgage broker that even knows the name of the credit score they use. Now you do. It's called the Mortgage Industry Option Score. That's what FICO actually calls this scorecard. So when you go in to apply for a mortgage, you're pulling a Mortgage Industry Option Score, which is much different than the normal consumer score you'll pull. So the mortgage score won't be the same as your auto score. Okay, it's not, because that's an auto industry option score. Now you know something most car dealerships, almost any car dealership you'll ever talk to doesn't even know. That's the name of the actual credit score that they use to pull credit. So if you look at an auto industry score versus a mortgage industry score, the two are different because the auto score weighs past auto history heavier to the score makeup than the consumer scores. So these different scorecards are designed to help specific industries better determine risk, and due to there being so many industries that offer credit, this is also why there's just as many scores as equivalent. I get this question all the time. Why are there so many credit scores? Now you know. You know because each industry has its own scorecard that gives more weight towards accounts within their industry because they feel that helps them make better lending decisions. Because after all, okay, everybody is going to care about what's on your credit report, but if you're getting a credit card, they care most about how you pay your credit card history than anything else. The same with a car loan, the same with a mortgage. So let's talk about the credit bureau score, Vantage Score. Okay, there are different scorecards that FICO offers, but there's also different companies that offer credit scores. Remember, when I showed you those acquisitions, almost all of those companies offered analytical scores. So they all offered a kind of credit score, and FICO came in and bought them up. The truth is there are hundreds, if not thousands, of companies out there that offer analytics that tie into credit scoring. Okay, but obviously FICO is the major one that we all hear of. But there is another one that you're going to probably hear of known as Vantage Score. So even though FICO is the biggest provider, the credit bureaus themselves decided to get into this game. Why wouldn't they, right? So all these people want FICO, they're getting FICO, the credit bureaus go, wait a second, we're leaving major money on the table here. We need to come up with our own credit score. So that's exactly what they did. They came up with their own credit score known as Vantage Score. You might hear this actually referred to as Advantage Score 2, which is actually incorrect. It is Vantage Score, and even though even on the slide I have it as 2 words, it actually is even 1 word. So Vantage Score was unveiled by the 3 bureaus in 2006. Okay, and all 3 reporting agencies use the same formula to calculate the actual Vantage Score. Now, Vantage Score has had in the past scores as high as 990, while FICO scores can only be as high as 850. So what would happen is, like, you would pull up, and I'll give you a perfect example. True Credit used to offer the Vantage Score. I bet they still might. That's who I always used to use. So you would pull a True Credit report and you'd be like, man, I'm awesome. Like, I have a 700 score. But the problem is that it was a Vantage Score. And Vantage Score 700 is below average. It's not good. 700 in the consumer FICO world is good. So this is one of the main problems from the inception of Vantage Score, was being that it went to 990 instead of 850, someone would pull a 700 and think they'd have good credit, but then they actually wouldn't. And we saw a lot of this when customers were actually enrolling to have their credit fixed. They would pull True Credit, they would see their credit be good, then they'd go in to get a mortgage and they'd be like, what happened here? Like, I pulled my Vantage score and I was 700. They pulled my other score and it was 550. Well, first, they're pulling an industry-specific score. And second, Vantage is much different than FICO, 150 points or 140 points higher on the high score than actually FICO has. So, for example, when you look at what Vantage score was when it rolled out, A credit was 900 to 990. B, 800 to 899. C, 700 to 799. D, 600 to 699. F, 501 to 599. This is a big deal because people would think they had good credit at 700, but that's a C credit rating with Vantage. That's not good. You'd have to have 900 plus to have good. But most people that are used to FICO would think they would have good scores with Vantage, which they wouldn't. So obviously this created a real problem, and this is one of the reasons most lenders never adapted it at all, okay? Because you can imagine a bank now having to teach all their employees that 700 is now no longer good, it's now bad. Okay, that's a huge task at hand. So this is one of the main reasons that this was never widely accepted. So the bureaus have now changed their score last year, okay, with Vantage Score 3.0. And with the new Vantage Score, scores only go as high as 850. They mimic the top FICO score. It makes a lot of sense. They had to conform. It had to be done. As a matter of fact, I remember years ago in 2004 or 5 when they were getting ready to release Vantage, and I said the exact same thing then. I said, that is absolutely ludicrous. You can't change the way that everybody in the financial services does business because you want to roll out a new score that's way different than FICO. It will never fly. Well, it never did fly. What happened was they rolled out Vantage expecting all these banks, all these people to jump on board, and less than 4% of all financial services companies even did anything with Vantage Score. Even when the bureaus were providing it for free, companies didn't use it because it caused such confusion. So with the 3.0 version, now the Vantage Score only goes as high as 850, a really similar score range as FICO. So now we've talked a little bit about the different scores that are out there. Now you have a little bit of insight of why there are different scores. So let's dive in now to how these scores are actually calculated. Well, here's a quick synopsis of Vantage versus FICO. Now, don't feel like you have to aggressively write all this down because I'm getting ready to dive into each one of these sections individually. But this will give you, since we just talked about Vantage and FICO, a good comparison between the two. You can actually see how they actually calculate their scores. Payment history, utilization, balances, depth of credit, recent credit, available credit. So this is your score, 100% of your score. And your score is made up of these components right here. Now, FICO is based on 5 and Vantage is based on 6 factors. But each one of these factors carries a certain weight into the total score, whether it be 7%, 32, 35, or 10. And if you add all these up, you get to 100. Each one of these contributes towards the overall score makeup, and then when you add them all together, you get your total score. So let's dive in a little bit deeper. So Fair Isaac and Vantage Score hold their credit scoring formulas obviously very close to the vest, right? It's like, Coca-Cola's formula. It's legendary, that's something they don't want to let the cat out of the bag, which is why most people don't know about it. So this can be obviously frustrating because you can see items on your credit report like that you have too many revolving accounts, but you don't know what that means. Like, you don't know until you're done with this webinar exactly how many revolving accounts they really want you to have. So fortunately, Fair Isaac and Vantage Score have issued some public information about how they calculate credit scores. So after this, it's no longer going to be a mystery. You can know exactly how these scores are calculated. The biggest factor with Vantage and FICO, and I'm going to stop talking as much about Vantage because they don't really matter. Not a lot of people use them, and we're here for a FICO webinar anyways. So when you talk about FICO and Vantage, but mostly FICO, the biggest amount of the payment or of the overall score is payment history. So the top rated factor, it accounts for 35% of the total score is payment history. It's because the lenders want to know a person's payment history, right? Past and present. So this can be broken down into a few different things. Recency, the last time a payment was late. The more time that passes, the better. So if you have late payments on your credit report, one of the best things you could do to improve that is let time pass. And the longer those late payments are, then the lower impact it will have on your score. Frequency. Okay, do you have a lot of late payments? One late payment looks a heck of a lot better than a lot of late payments. Severity. A payment 30 days late is not as serious as a payment 60 or 120 days late. So how late were you will impact this aspect of the score. Collections, tax liens, foreclosures, repos, charge-off, bankruptcies are credit score killers. So this means certain types of accounts, late payments, will hurt your score more severely than other types of accounts will. Okay, and this is why, mortgages and auto loans, you want to try to always make sure you pay first. You want to always try to prevent charge-off, bankruptcies, judgments. These things can absolutely destroy this aspect of your credit score. So you can improve this aspect of your score by paying your bills on time. Pretty obvious, right? You pay your bills on time. That's what they're looking for. You improve that aspect of the score. Also, the more accounts you have paid as agreed to offset the ones you don't will also help your score. People ask me this. They say, Ty, what can I do to improve this aspect of the score? Not much, because if you paid it late, you paid it late. But one of the things you can do is you can put a bunch of positive payments on there that you're paying as agreed. The more positive accounts you have on there paid as agreed, the more you'll offset the damage of having a late payment. And a lot of people kind of boast nowadays. Well, I don't have a lot of credit. I don't have a lot of debt. Well, that's great. But the problem is if you only have 3 or 4 or 5 accounts reporting on your credit report and you were to ever have a mishap and go late on one, you'll destroy your scores. But if you had 20 accounts on your credit report and you went late on one, you wouldn't have as much of an impact because you'd have more positive on there than negative. Now, if you do have late payments, reporting on the credit, you can offset these by adding new positive accounts and making sure that you have a lot of accounts you're paying as agreed to offset the accounts not paid as agreed. So that is one thing. If you have damaged your credit because you paid it late, then focus on getting new credit and paying it as agreed. And by paying more new credit as agreed, you'll help offset the damage of those limited accounts that you actually didn't pay. So how much is owed is the second biggest factor of your credit score. Okay, so this part of the score looks at the total amount owed on all accounts as well as how much you owe on each individual account. Now, I want to just throw in something here that's on the slide. This is why most people don't know this. When you get a mortgage or you get any kind of loan, a mortgage or car loan most common because that's what most people get, your scores will bottom out for the first year. They won't drop 200 points, but they'll be much lower. Okay, and again, I get this question just the other day. Somebody said, I don't understand it. I have 2 accounts on my credit report and my scores dropped this much, and in the conversation they'd mentioned that they got a new car loan. Well, the getting of a new car loan is what did it. When you get a new installment loan, you might expect your score to drop 20 to 100 points because of this factor. You got a loan for 10 grand, you owe 10 grand. You owe exactly what you originally borrowed. So since 30% of your score is made up of what utilization you have, what percentage of your high credit limit you're using, in this case, you're 100%. You just got a loan for 10 grand, you owe 10 grand. So because of that, your scores will always go lower for usually the first year that you get a new mortgage, auto loan, or other consumer loan, for example, a signature loan. So using a higher percentage of the credit limits will worry lenders and hurt the scores. People who max out their credit card limits on revolving accounts have a much greater risk of default. Now, if you think about this, it kind of makes sense, right? The way I explain it is this. FICO can't look at your bank account. They don't know how much money you have in the bank. But the way they look at it is the more money you have, the more equipped you are to handle potential problems, right? Like, let's say you get hurt, you're out of work for 30 days. Well, if you had $50,000 in the bank, that's going to have less of an impact, and you're probably not going to pay your bills late because you go get the money out of the bank to pay your bills. But if you had $5 in the bank, you could have real problems. You have no money left over, you can't pay your bill. So since FICO can't look at your bank account, they look at your revolving credit limits. They say, look, you got 20, 30, 45, $10,000 in available credit. So if an emergency happens, you got a ton of available credit that can absorb that. You can use your credit cards to pay your bills till you get on your feet. But if you've maxed out all your credit cards or don't have available credit, then your scores can be much lower because then if an emergency happened, you're kind of done. There's not a whole lot you can do. So when it comes to revolving credit card debts, the formula looks at the difference between the high limit and balances. So for example, let's say you have a credit card with a $10,000 limit and you spent $2,000 on it. Well, that's a 20% utilization ratio. So the lower the ratio, the higher the score. The bottom line is you want to use the credit cards, but you want to pay them down as close to zero as you can every month to maximize this aspect of the score. So if you're looking for a quick credit score boost, pay down any accounts you can. Wow. I closed a lot of mortgage deals back in the day based on this piece of advice. Somebody would come in and want to get a mortgage. They would have a score that was 10 or 20 points too low. I would have them pay off their credit cards. Their score would raise by 40, 50 points. We would secure the home loan. If you're looking to get a car, if you're looking to get a mortgage, and you want the one big thing that you can do to have your score as high as possible when you walk in the doors, pay down your credit cards to zero or as near as zero as you can, and you will see an immediate score spike. The minute that new balance is reported, your scores will go up, and sometimes it's substantial. I've seen people's scores raised over 100 points just by paying down revolving accounts. So with FICO, 30% of the score is based on utilization, while 35% is based on your payment history. That means utilization is the second highest weighted aspect of the score. It means if you're overutilizing your revolving accounts, you can damage the score almost as much as if you were paying your bills late. That's crazy, right? But think about it. Look, it's just math. It's simple math, right? 35% is payment history. 30% is utilization. If you overutilize your account, because these two have almost the same value aspect of the score, you literally can hurt your score as much as paying it late. This is a conversation I had last week. Last week, one of the biggest, a representative from one of the biggest lenders in the country that do cash flow financing came down to visit us. We do tons of revenue financing, cash flow financing loans. And we were sitting at lunch. This is what he said. He goes, I just don't understand the credit score. Sometimes I get people with 700 scores that have late payments. Sometimes I get people with 550 credit that, to be honest with you, doesn't look that bad. And I said, this is why. And we started talking about this. And the one thing I said is, I'll tell you exactly why that happens. The guy with the 700 or the guy with the 550 had revolving accounts open and low utilizations, didn't he? And they said, yeah, that's commonly what we see. And we got into this factor. And he was really astonished to realize that paying late is almost the equivalent of utilization. So even though 550 score people might have some late payments, the utilization can make all of the difference. By having a lot of available credit, they can really improve their score up to a 600 plus if they wanted to. Whereas the 700 guy that has late payments has the exact same scenario going on. The bottom line is that you can have a 700 credit score, okay, with some late payments if you have really good utilization. But if you had bad utilization and late payments, that 700 score would be down in the sixes. Utilization carries almost as much weight as payment history. So if you really want to know what you can do to impact your score, you add available credit to that report as much as you possibly can. As a matter of fact, this was one of our secret tactics that we used in the credit repair industry. What we had was a lot of clients would come in. We would fix their credit. It was ridiculous what we would do. And their scores wouldn't come up very much. And they would say, I don't understand it. You're getting all the stuff deleted. My score's not coming up. Well, the reason is because they didn't have very many positive accounts. They didn't have very much available credit. So we would go to these companies that would give them in-store credit that reported to the credit reporting agencies. Okay, there's a lot of these type of companies out there. And these people would give them $2,000, $3,000, $4,000, $5,000 credit limits only like in their internal store. But the minute we would add a $2,000 or $3,000 or $4,000 or $5,000 revolving account to their credit, it would spike substantially. Sometimes 120 points or more just because we added new credit, positive credit, being paid as agreed, and tons of utilization. Think about it. If you add a new account that's being paid as agreed that has a lot of available credit, you're impacting directly 65% of your score. Biggest, easiest, simplest fixed. Okay, if you have money and your credit, excuse my language, sucks, get a secured credit card. Put $2,000, $3,000, $4,000 on it, and when it reports, your scores will spike. It is the biggest thing you can do to have the easiest and simplest and fastest impact. Anything over 30% of the limit being used will hurt your scores. Okay, that means if you have a $1,000 limit, you owe more than $300, you're actually going to be hurting your score. So adding credit cards to your report with high limits can also significantly and quickly raise your scores. Again, sometimes as much as 100 points. This was consistently a tactic that we used. Now, I can't give you the sources that I used back then because they're no longer in business. The bureaus don't like them for this reason. They know that if somebody adds a $3,000, $4,000, $5,000 credit card account, that their scores will go up. They don't like that. They make more money on subprime customers. So they would just shut down the reporting of these cards. There's still a lot of these cards out there. I just off the top of my head haven't been active in there to throw out a bunch of names. So one more important tidbit is closed accounts do not help and can hurt if there's a balance remaining. A long perpetuated myth has been to close accounts that are not in use, but this can actually hurt your scores in several ways. As you know, overall and individual account utilization plays a major role in scoring. So if you close accounts, then you're actually lowering that utilization and you're getting rid of that positive payment history, which both adversely affect your score. So length of credit history, how long you've had credit for. This is less important than the previous factors. But it still matters. Okay, it's considered the age of the oldest account and the average age of all of your accounts. It's possible to have a good score with a short history, but typically the longer the better. So young people, students, and others can still have high scores as long as the other factors are positive. And this is one of the things I always say is it's impossible for like a young person to ever have an 800 score because of factors like this. It's hard to control length of history, but if you don't have good length of history, you can't have a great score. So with FICO, this is the third largest aspect of the overall score. Okay, this actually accounts for 15% of the overall score. The other remaining factors I'm going to show you account for 10% each. So now you know payment history, 35, 30% utilization, that's 65 in total score. This is 15%. Now with those three factors, you're now to 80% of the actual total score. So if a person needs to, if a person is new to credit, then there's little they can do to improve this. No newly added accounts can be backdated to improve this aspect of the score. I'm putting this here because I've tried to do it. Like I have friends that own companies that provide credit. So I went to them and said, listen, can you like put an item on the credit report and give it like 6 months worth of history? They can't. It's impossible. It can't be done. But I'll tell you what can be done is you can be added as an authorized user to a family member's account. Has to be family member. FICO 08 stopped giving you credit for authorized user accounts if they're not family members. But if you get added to a long-standing account of a family member, that's the only thing you can do to control this aspect of the score. You go to Grandpa. Grandpa's got like credit for like 50 years, and you say, Grandpa, will you add me to Chase? I don't even want the Chase credit card to use. I just want the credit to help me. Now you've got like a 50-year-old, like credit card reported on your credit report. 50 years probably isn't really accurate, but I'm exaggerating. Maybe a 10-year-old credit. That will spike this aspect of the score. It's the only thing you can do to improve this aspect of the score. So average age of account is another important reason to keep all accounts open. If you have multiple accounts that you've had for some time and you don't use them, then they're still helping your credit because you've got this factor tying into the age. So also make sure you use each of these accounts at least every 6 months. For you to get credit for paying the account as agreed, you have to have some kind of activity on it. So you don't want to keep large balances. You now know why, but you do want to keep using the actual credit itself to get credit for the payment history that you're actually contributing by paying that account as agreed. So credit issuers must reserve the money offered and credit limits for their clients' use. Okay, so they don't like having accounts that are big and open with huge limits that you're not using. So again, they'll cancel your accounts. You want to make sure you're using them. And additionally, credit reporting agencies will calculate an account as inactive if there's been no activity in 6 months. So if it's inactive, you're not getting any credit for actually paying the account as agreed. So new credit, i.e. inquiries, is not always a bad thing. However, opening new accounts can hurt a credit score, particularly if a consumer applies for lots of credit in a short period of time. Okay, the score factors that they calculate into this is how many accounts the consumer applied for recently, how many new accounts the consumer has opened, how much time has passed since the consumer applied for credit, how much time has passed since the consumer opened an actual account. Okay, so this model looks for rate shopping. So it takes into account that you're going to be dealing with car dealerships and mortgage brokers that were actually pulling your score a lot. Okay, we call this shotgunning applications. You go into a car dealership, you apply once, they send the application to 12 banks. Now you got 12 inquiries on your credit report. Well, auto dealers are notorious for running 3 to 15 credit reports. Okay, they call this shotgunning the credit. They'll pull your credit once, they send it to the bank pulls the credit, and all of a sudden you got 15 inquiries. Well, luckily to compensate, the score counts multiple auto and mortgage specific inquiries in a 30-day time period is just one inquiry. Okay, so that specific calculation for cutoff dates and types is confusing, but again, we'll go over that kind of a little bit later as we get in. The bottom line is that if you have 60 or 70 auto inquiries in a 30-day time period, it only counts as one into your score. They'll all show on your credit report, but it only calculates as one into the score. So if you go to get a mortgage and you have 5 mortgage brokers look at it or 5 banks, it only calculates as one inquiry. So as long as you do it in a 30-day time period. So if you're going to shop for a car, if you're going to shop for a mortgage, plan on doing the shopping within a 30-day time period so it will only calculate as one. So for most people, a credit inquiry really won't have an impact on your score. And people say this to me all the time. Ty, if I get an inquiry, how many points will my score go down? 0. Your score won't go down any points if you get an inquiry. That's not how the section of the score works. It's groupings of inquiries that will adversely affect your scores. Very important to know. An inquiry has no impact. You can pull an inquiry, have your credit pulled today. Your score won't drop a point. You could have 5 inquiries this week and your score could drop 30 points. The pulling of your credit, an inquiry, is not going to lower your score. It's groupings of inquiries. It's pulling 2, 3, 4, 5, 6, 7, 10 in a short period that will actually lower the score. So inquiries can have a greater impact if you have few accounts or a short credit history also. Large numbers of inquiries also means greater risk because what they're thinking is you're getting turned down or you're trying to mass accumulate credit. Either way, it ain't good. Because think about this. We exclude auto, we exclude mortgage, so the only time you're going to have a lot of inquiries is if you're applying for other loans or credit cards. Well, if you're applying for tons of loans and credit cards, one of two things is happening. One, you're getting denied everywhere you're going, which is an alert to the credit bureaus and FICO. Or 2, you're not getting turned down, but you're accumulating massive amounts of money for some reason. Either one, red alerts, your scores will go down. It's why groupings affect you. So according to myfico.com, people with 6 inquiries or more on their credit reports are 8 times more likely to declare BK than people with no inquiries on their reports. Okay, this is why FICO exists. It's analytical data. No normal person would think that 6 inquiries would 8 times your risk of bankruptcy, but it actually really does. So this is reason that these groupings of inquiries lower the score. Types of credit used, or depth of credit, or mix of credit, as FICO calls it. Okay, everybody wants to see you have a healthy credit mix. They recommend you have a balance of both revolving debts like credit cards and installment loans, like auto loans and mortgages. The preferred number of credit cards reporting is 3. So that is the preferred number. Bottom line, if you want to know how many credit cards you could have on your credit report to impact your score the best, the number is 3. Now, here's where we get into a little bit of gray area. People will say, Ty, you said the best number is 3, okay, but I have 5. But you also said that, length of credit history also ties into this. So what do I do? Do I shut down the accounts? There is no right answer there, okay, because you're getting deep into the analytics that are FICO. There's no way of knowing. So you have to look at that. Don't just shut down your credit cards because you have 5. If you have 10, start shutting some down. You might have an immediate impact on your score, but it's not helping you to have that much credit. If you have 4 or 5, no big deal. It's not really severely hurting you, and you're probably making up for the damage in this area of the score based on contributing to the payment history, utilization, and length of credit history. So you got to look at those things. How old is the account? How are you utilizing it? What kind of available credit does it have? Now you know the math of the score, so you'll know if it's helping you in other areas that are more than this, which is 10% of the scores, don't shut down the account. Like if you got a long-standing credit card account with a really high limit and low balance, don't don't shut that thing down. You're paying it as agreed, 35% of the score. Utilization is good, 30%. And link to credit history. 80% of your score is being impacted positively by that account. So who cares that this 10% is being hurt if 80% is improved? It's just math. So you wouldn't want to. So those are some of the things you have to look into in deciding that. You shouldn't have more than 2 mortgages reporting. If you do, you'll lower your score. You shouldn't have more than 2 auto loans reporting. If you do, you'll lower your score. And installment loans also score better if you have 2 or less. Those are the preferred numbers. Bottom line, that is credit mix. 10% of your score is devised by credit mix, and here's what they want to see. 3 credit cards, 2 mortgages or less, 2 auto loans or less, 2 installment loans or less. So here again is how your FICO score breaks down. So let's summarize kind of what we've went over. 35% of your score is based on pay history. 30% of the score is based on utilization. 15% of your score is based on the length of credit history that you actually have. 10% of your score is based on new creditor inquiries. 10% of your score is credit mix. Add it up, you get 100%. That's how your FICO is calculated, just that simple. Now, not only have I taught you how it's calculated, but now I've even told you how to improve every single aspect of the score. I've even talked to you about adding positive accounts with high limits and utilization being the easiest, simplest fix you can go and do for a score spike. Whether you're applying for something and you just need a score bump, now you know what to do to actually get it. So let's talk about FICO 09 because it's brand new news, just rolled out. So FICO's newest credit score is known as FICO 09. Now this new score includes many changes from previous FICO models. One change is that medical collections are no longer scored the same as regular collection. They're weighted much, much less. Now FICO anticipates that a consumer with median credit score of 711, whose only negative collection issue is medical related, will see their score increase by 25 points. So that just gives you some kind of general idea of what this change could actually translate to score-wise. Someone with 711 collections that are only medical, now their score will be 25 points higher because those collections are only medical versus if they were non-medical. Okay, other changes in the model will better gauge the ability of a consumer who has limited credit history, known in the business as a thin file, to repay a prospective debt. We used to call this a false high in the mortgage business. You get somebody with a 700 score and they had 1 account reported that they paid as agreed, or 2 accounts. It was kind of crazy. It would happen once in a while. Called a thin file, called a false high. FICO's now made corrections to better assess risk for this type of person. So these types of people might not have a score in the past, but will now have with the new version. So they'll now have a score and it'll be scored a little bit differently. Non-traditional credit such as your residential rental history will be taken into consideration. That's a huge deal. Very frustrating in the mortgage business because we used to try to help people get home loans. They'd been in a house for 3 years, paid their rent perfectly, and it had no calculation into the score. Now those can be added to the credit and can have an impact to the score. So this means consumers have little or no credit history, must pay rent on time, and if they do, they'll actually get a boost. Paid off and settled collections will be ignored with FICO 09. That's me clapping. Thank goodness, FICO, for wising up. One of my biggest frustrations with the FICO score is you could pay off a collection, but what used to happen was you would trigger the date of last activity. So by paying off the collection, okay, then you would basically, you could let it go. Okay, and then what would happen is you'd make a payment on that debt and it would all of a sudden be recent. So you pay off your collection, you hurt your score. Crazy, but it's the way that FICO used to be. But now as long as the collection is a 0 balance, it'll be ignored. It's not even calculated into your score. Again, clap, 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 FICO. Great job. Because it used to be you come in, you had a $400 collection, you'd pay it off, your score would go down because now it would show as a recent payment. They would update the date of last activity to show that you just recently made a payment. Remember, late payments that are older have less of an impact on the score, right? So if you had a collection that was 5 years old, it wouldn't really impact your score. But you'd pay it off, now you'd have a recent payment on that account, you'd hurt your score paying off the collection. It was insane. We used to tell people never pay off your collections unless they agree to delete it. FICO's figured this out. And now finally, they're not going to calculate into your score. It'll still be on your report, but not calculated into your score when you actually have a paid off collection. This is huge as paying off a collection used to really hurt the score. Now it doesn't. So how do you rate? Well, here it is for FICO. There you basically go. Gives you a pretty good idea of how FICO looks at this. 750 plus, excellent credit. 700 to 749, good. 650 to 699, fair. Poor credit, 600 to 649. Bad credits below 599. Look, there's a lot of ways you can look at it, but this is the most recent data from FICO of how they actually rate your score. So this is where you're falling. Don't forget, you could go to True Credit or a place that gives you Vantage Score, and your scores might not be reflected exactly the same, but this is how FICO weights your score, and a lot of people in the lending industry also do. So let's look at some final tips here to raise your score. Pay your bills on time and beg for forgiveness as you pay late. Look, a lot of people don't know, but let me clarify some things. It is not the law that anybody has to report your credit data. They can by choice report it, they can by choice remove it. So I found a lot of companies in working in credit repair, if you call them up, there's a lot of companies that have a standing policy that they will forgive you one time. So if you went late on a payment, you said, oh my gosh, you call them and beg for forgiveness, in a lot of cases, they'll wipe out that late payment. Now, I'm not saying this will always work, but a lot of companies surprisingly have a protocol built around this. So if you do pay late, don't just punish yourself. Call them and beg for forgiveness. You might have a chance. Have lots of positive credit on your report and make sure you're using it at least every 6 months. Don't forget to have a good credit mix. So it's not enough just that you have a lot of positive credit. Remember what we talked about. Don't excessively get credit cards or anything else. It can hurt you. Have open credit cards, 3 preferably, and keep your balances very, very low. Remember, the lower the balance, the greater impact of the utilization, which is 1/3 of your total score. So also get the highest credit limit accounts you can get. If you're going to shut down accounts you don't use, shut down the ones that are the newest with the smallest limits. That's going to give you the best impact to your score, or not impact your scores adversely by closing the accounts. If your credit file is new, get added as an authorized user, but only on a family member's account. This will impact that time in bureau aspect of the score. And do not apply for too much credit all at once unless buying a car or a home. Then you can do so within a 30-day time period. So those are some good final tips to maximize your score if you're getting a car loan, getting a home loan, or just want to have overall good credit. So I got to wrap this up. I don't have time for questions. I know some people have typed in questions, but I don't have time. I'm going to another webinar literally right now. I have somebody Skyping me that's going to be my guest speaker on that webinar. But here's my email. Just take your question and just email it to me. I will make sure that any questions you have are answered. Ty@creditsuite.com, ty@creditsuite.com. If you are interested in getting more information about building a business credit profile, getting financing for your business, or offering business credit and financing as a service and making like a ton of money, then there's a website you can check out too, creditsuite.com/business credit. And that'll take you into a very special exclusive webinar that tells you more about what we do. As you can see, there's no pitch here today. I'm not selling anything. This is just to give you free information. I hope it helps you in your lives. But if you do want more information about getting corporate credit, getting credit for your business, getting money for your business, offering as a service, check us out, creditsuite.com/business credit. You attend the webinar all the way through. I'll send you a playback probably as soon as tomorrow, so you can stop it, play it, go back. If you have any questions, send me an email. And as in all my webinars, I hope you leave this with a lot of good, valuable, actionable information that you now have that you didn't have coming in. I hope you learned some things. So thank you very much for carving an hour out of your day today. I really enjoyed having you. Thanks very much for taking the time to attend this webinar.